You have written and spoken a lot about the global financial crisis of 2008. And now looking back 6 years or so from the epicenter of that, I wonder if you could identify 3 or 4 lessons from the crisis that you would hope policymakers would be able to digest, or that they would have digested in terms of their outlook for the future. And I realize that this is a subject that will be debated for many years, and that some people can identify 12 causes or 12 lessons. But I just want you to center on just the few that you think are really important. And I'm not holding you to saying these are the only ones that are important, but the ones that you think, that come to your mind.
Well, as you say, it's still a bit early in a way to come to definite conclusions. And if you imagine what it must have been like in 1936-37, looking back to 1931 and saying, well, what are the lessons? I think it took another 20 years before we felt that we'd absorbed them all. But I think for me, the following come out. The first is that we went into the crisis thinking that there wouldn't be crises, that we'd somehow solved them through a combination of technical advances in economics, application of Keynesian economics. We were just not as dumb as the people in the past who made mistakes. That was clearly wrong, and we should have learned from the fact that in the Asian financial crisis, a lot of very talented policymakers in Asia got themselves into difficulty. And in the rest of the world, we rather assumed it was their responsibility. So I think the big lesson for policymaking for me is to think of crises as normal. They won't happen all the time, they won't happen on a predictable frequency, but whatever policy framework you have has to be able to adapt and cope with crises. And that was perhaps where our monetary framework was weak. So it's, the first lesson I would say is that we need to integrate the understanding of monetary policy in normal times, where I think inflation targeting did extremely well, with the understanding of monetary policy in what you might call wartime or in times of crisis. And I think what both have in common is that the central bank or the authorities have to make a judgment about how much money they need to inject into the economy. And that changes very significantly when you're dealing with a crisis and also when you're coming out of it. So I think that's the first lesson. The second one is that the big weakness in the policy frameworks going into the crisis was not the way they were constructed or organized or managed. It was the intellectual framework that we were using, which tended to be of a very simple kind used in textbooks on macroeconomics, one commodity, underlying constant growth trend, deviations of output from trend give you an output gap. What there was no room for was either the fact that individuals in a world of tremendous uncertainty can make big mistakes, and these mistakes accumulate, and then suddenly you get the need for an adjustment, or the fact that you can get a significant disequilibrium in the economy, both domestically and internationally, in terms of the balance between savings and spending. So I think, for me, before the crisis, people simply had not realized that they were spending more than was consistent with what they would come to believe to be their long-run permanent income within countries, a disequilibrium internally, and across countries, of course, some countries were borrowing a lot and others were saving a lot and lending it. And I think these international imbalances were very important. It wasn't the only factor going on, but to my mind it was a very big factor. And I don't think our economic frameworks underlying policy really got to grips with this. And why was that? Well, I think it's partly because maybe in central banks, or certainly I think in the commentariat, there was a view that economics has a model. And there's a model of the economy, and central banks have econometric models, and there is a model that we should all use. And I think that's extraordinarily dangerous. If you open the pages of any economic journal, you find dozens of models in one issue, each model being constructed to throw light on a different problem, to answer a different question. And I think that the model that was being used to understand issues of time and consistency in monetary policy, issues of credibility, the case for an independent central bank, rules versus discretion. All of those issues, the standard one commodity model made a lot of sense, and they were very helpful. And exogenous stochastic shocks, which averaged around zero, sometimes positive, sometimes negative, policy being to respond to those shocks. All of these things made sense in the context of those questions. But when it came to understanding the imbalances in the world economy, the fact that people may have made mistakes about their future permanent income, the model was inadequate. We needed a different model. And in a completely abstract sense, economics has no difficulty with that concept. Different question, try a different model. But it wasn't used in the policy debate. And I think that was another big lesson for me. I think models have been as much a handicap as a benefit in thinking through policy. I remember going before the Treasury Committee regularly and giving evidence in Parliament. And they'd always say, well, what does your model say? And I would say, well, which model? And they'd say, no, but your model, the Bank of England model. And I'd say, but there isn't one model. A model cannot be a pictorial representation of the world. It's a way to abstract from many issues to help you concentrate laser-like on one aspect of a problem and think it through. But that's not the way people out there think of economics. They think of economics as having a model about the world, and it's either right or wrong. So that's a second lesson. And I think a third one, which we've been talking about for a long time and trying very hard to get people in outside the academic world of economics to understand, and I think it's a very important question for economics, is that we should not pretend to be able to forecast. We can't forecast. The future is unknowable. We can make intelligent statements about the odds and the likely reactions of people in certain situations. And I think that the ceteris paribus analysis of how individuals respond to changes in interest rates or changes in tax rates is a very helpful theoretical framework, and it has a lot of empirical value too. But when you're thinking about the world economy as a whole and looking to the future, you can't assume ceteris paribus. We simply don't have the ability to forecast easily. So that for me was the third big lesson.
So let me ask you a question about each of these, just in the interest of clarifying. If as the head of a central bank, you adapt a philosophy that you always have to be ready for a shock. I think that's what you were saying. That
Yes.
was your first point. That no matter how stable conditions are, you have to be on a war footing because shocks, crises will happen no matter what. Could you just elaborate a little bit? So what does that actually mean other than being on high alert? Go ahead.
I think it's to do with the framework which we use both for policy and also financial regulation. So in terms of policy, I think it's very important to get across the idea that setting monetary policy is about telling a story. It's about a narrative. Given where we are now, it is reasonable to assume that the following things may happen, or there's a balance of risks. This is why we've taken our judgment. But we don't pretend that we know. We pretend that there are good arguments on the other side. But we have to make a decision today. We can't simply abdicate responsibility and not set interest rates. Given what we know today, this looks to be the best interest rate. But always to alert people to the fact that unexpected things will come along. I think what that means in particular is that you shouldn't try to forecast your own intentions. So I have some skepticism about forward guidance, for example. I understand why it was done, and I think it was important to reassure people that if interest rates were to start to rise, then that did not mean that they would suddenly go on rising rapidly back towards an historically normal average level. But telling the narrative, I think, is the more important thing. And it's creating that line of permanent communication between not just financial markets, but the business community and, if possible, a wider public and the central banks. Because if you pretend to be able to say this is what we're going to do, raise rates next July, the chances are you won't do it sensibly because the world will have changed. But then if that's what you said you would do and don't do it, people lose faith in you. It's very important they understand, and we try and get across to people that this is a an area where we are dealing with something inherently unknowable, and we have to be prepared to change tack quickly. What's important is that they understand what the objectives are that we're trying to achieve and how we think today about how the economy works. But that's going to be an evolving story, so you need to tell the narrative and keep it up to date. I think on the financial side, it means focusing on things like resilience and actually saying there's no. I mean, very often people now say to me, where will the next financial crisis be? And the only honest answer is we don't know. Before 2008, I think everyone in the international community accepted that what was happening in the world economy was unsustainable. The imbalances could not go on. At some point it would have to come to an end. No one knew when. And we talked at the IMF regularly about how would it come to an end. And I think the single most likely scenario that was painted was a sudden, very sharp fall of the US dollar. No one actually said, well, the US banking system will collapse. I think it's impossible to pinpoint where the crisis will be. What you need to have is a system both of financial institutions but also of policy making that's fairly resilient to whatever could possibly come along. And I think that another lesson that I learned in area of regulation was that for reasons that looked very sensible at the time, we decided to separate regulation of the financial sector, including banking, from monetary policy, which stayed with the Bank of England, and we created a new regulatory agency. And in normal times, there was a lot to be said for that. But when it came to an unexpected shock that led to wartime, then the central bank, as a lender of last resort, was in a very difficult position. We knew nothing about the liquidity position of the banks to which we were likely to have to lend, and the regulator didn't have the information to give to us. And I think one lesson I learned from that was that if you are going to have to supply money to the system in times of crisis, then you need to be able to do that at any point, not just once the crisis has started, but be ready to do it. And I think that changed my view about where prudential regulation should be located.
So would I be right in interpreting, if I take your three lessons, that it amounts to, first of all, a huge dose of humility about what you know, and especially how far out you can know it. And the flip side of it is it requires enormous sort of tactical flexibility, which I would interpret, or I'm assuming that means that part of the framework of no permanent normalcy means a lot of flexible authority, because what you're really saying is you don't know where a crisis. You're saying this: we're going to have crises. We don't know where they're going to come from. We're not going to signal. We're not going to give the impression we do. But when it happens, we have to be able to employ lots of instruments, because for the very reason we don't know where the crisis will come from, we can't have a prepackaged response. So am I right? You're painting a picture of at least ideally, much more flexibility on the part of the central banks to be able to intervene in different ways if they have to.
So up to a point, and I think there are two aspects to this. The first one, if you like, is the intellectual one, which is not to pretend to the rest of the world that we can predict what will happen in the way that scientists can to a system that they can observe. I don't think economics should apologize for what happened in the crisis, because all the people I met during the crisis who had the most interesting and helpful things to say were trained economists. And I think economists can think through these issues better than people without the benefit of that training. But what I think was a mistake was to pretend to the rest of the world that we have quantitative models that will predict things. We don't. And that somehow small changes to our intellectual framework are appropriate. I think, for example, the idea that if you just introduced into some of the conventional macroeconomic models a little financial friction, then we brought in financial factors, and now our model will understand and help us explain the next crisis. I think that's a mistake. I think there are bigger things that probably need to be done. But after all, economics has always been much bigger than the standard new Keynesian macroeconomic paradigm that is currently used. I mean, if you go back to the 50s, I think Patinkin, Tobin, Meltzer, all these people had a much broader view of monetary policy and how monetary policy worked than has been considered normal recently. And I think you see this very clearly in the description of the asset purchases undertaken by central banks, described as unconventional measures. Well, the idea of creating money and buying government assets in order to give money to the people who sold the assets to you is a very conventional, old-fashioned monetary policy instrument. There's nothing unconventional about it. What is novel about it is the sheer scale of it, which is unprecedented in the post-war, probably ever, the scale in which it's been done. So I think it's not that there's anything wrong with economics, but I think that the idea that we should simply say this is the model for understanding all macroeconomic issues, and moreover we can quantify it and make quantifiable predictions, it was a dangerous illusion. I think the second area that matters is the question is flexibility of policy instruments. And I think one has to be very careful here, because I do not want central banks to be put in a position where they are regarded as so powerful that they should be given enormous latitude, or think that they have to use a wide range of policy instruments, even if Congress or Parliament has not delegated those instruments to them. And I do think my own view in the crisis was that it was extremely important to distinguish between what central banks could do, which was basically create money or provide liquidity, and what governments could do, which was inject capital and take risks with taxpayers' money. Those are fiscal or quasi-fiscal actions, which even if the central bank is involved in advising or even implementing in some cases, the responsibility for the judgment as to whether it's sensible to risk taxpayers' money needs to stay where it should be, fairly and squarely on the shoulders of politicians. Otherwise, what will happen is, as I think you can see to some extent with the Fed and perhaps one or two other central banks, that after the event, whatever the politicians said behind closed doors at the time, they will not be shy about blaming the central bank and saying, well, I don't know what authority they had to do that. We better curtail their remit. So I think it's open-mindedness, but it's also a realization that incentives matter. I mean, one of the things that was very clear in the crisis was that on their own, no one had much incentive to do anything. And the imbalances internationally continued because it proved very, very difficult to lead to any coordinated change or response. You see it now. The world is operating well below a normal level of activity. There is scope for a great deal of recovery in world demand and output. It's not coming, and every country is saying to itself, if only the rest of the world could grow normally, we would be all right. But since the rest of the world isn't, maybe what we should do is to push down our exchange rate, at least temporarily, in order to use that as the only remaining policy instrument to boost domestic demand, or to boost total demand, using external demand. And I think if every country feels they're in that position, you end up with a situation which isn't a million miles away from how the Brazilian finance minister used to describe currency wars.
Right.
And I think we're moving towards that. So, it's partly intellectual humility. It's partly the recognition that since we cannot forecast precisely where the crisis will be or in which financial market, the solution is not to pretend that we should monitor every financial market in the hope that we'll spot it before it happens. It's to build a system that if there is an unexpected shock, the system itself is more resilient. And that speaks to what you have to do well before the crisis. But I think the idea that just by throwing resources and people and money at the problem of monitoring, then we're going to spot where the next financial crisis will be before it comes, I think is a mistake. Because before 2008, first of all, people did realize that what was happening was unsustainable. But I don't think there was any way in which by monitoring any one market that you could realize exactly what needed to be changed. And if you had done, I think the problems in part would have been to get agreement collectively on the action required to deal with them.
So let's look ahead now, and I'm going to ask you sort of a two-part question. One has to do with regulators, regulation of the financial system. If taking into account everything you said, let's call it, a very humble approach to knowing what could happen. But on the other hand, assuming that it is inherent in the financial system to have instability and crises, what are the 2 or 3 things that you hope or that you feel will be the most important challenges for regulators over the next decade? Given the range of things that they could do, what's most important and what's most difficult?
The first thing, I think, is that everyone recognizes the need for more loss-absorbing capacity, it's called, in the banking and financial system more generally. My own view is that common equity is the best source of loss-absorbing capacity, and we, over a long period, need to boost significantly the amount of equity which is used to finance banks. That's been a subject of debate, clearly, and I think we have still a long way to go. The second is that the provision of liquidity raised a number of quite major practical problems during the crisis. One was that the idea that we simply apply budgets, lend freely against good collateral at a penalty rate, turned out to be very difficult because there wasn't any good collateral to lend against, so we had to lend with significant haircuts in some cases. And it proved very difficult actually to implement penalty rates. And I think for me the lesson from that is the sensible thing is to try to devise a system ex ante which will ensure greater certainty about the access to central bank liquidity that banks can get. So I do think it is possible to almost require them as part of the regulatory framework to pre-position collateral so that the central bank can examine the collateral which it might have to take on a regular basis, so that when you get the call at 3 o'clock in the afternoon, I can't get through overnight, I need to borrow 10% of my balance sheet from you tonight, oh central bank, otherwise I'm going under. The central bank knows exactly what the collateral is that it will take, what the haircuts are, and the other bank, the commercial bank borrowing, knows what collateral it's going to deliver and how much cash it will be able to borrow from the central bank. And there need to be clearly regulations to ensure that, given the asset structure, the bank will be able to borrow enough from the central bank to meet what is thought to be a reasonable degree of uncertainty about those needs. And then in that case, it might be possible to ease off on the penalty rate. Right. Because we came under enormous pressure from politicians and banks to lower the penalty rate on the grounds we're in a crisis, all this stuff about moral hazard, it's all very well, but actually we better give them the money. And of course, many people had said to us before the crisis, we sent people around financial institutions to ask them where they saw the big risks. And the last question was always, well, so where's the really big risk that you haven't mentioned yet? Oh, we're not sure, but it doesn't matter. And I said, what does it mean it doesn't matter? Well, if it's that big, it'll be your problem, not ours. And so they're perfectly well aware that the central bank will have to take responsibility for the financial system. And I think we need to do more ex ante to deal with that. I think the third area that worries me a lot is that the idea, it goes back to what I said earlier about uncertainty. The idea that even the best intentioned and best informed central bank officials can design a set of risk weights to calculate risk-weighted capital, I think is a myth. Whatever the risk weights are that are appropriate today will be inappropriate in a short period of time, and they'll certainly be inappropriate during a crisis. How could it have been that central bank officials, with the best of intentions, without any attempt to distort the system, ended up with a system where mortgage debt had a very low capital weight and where sovereign debt had a zero risk weight, despite the fact that it's turned out in many cases to be highly risky? None of these things were easy to foresee. And I think you can't change risk weights just like that in an internationally agreed system. It is much better to have something a lot simpler and more robust. It's an old saying that simple rules of thumb can actually be better than an optimal solution in a complex system. Because if you've misspecified how that complex system works, then the bias you get through misspecifying that model can often be very much bigger than the error you get by using something that's a simple approximation. And I think that is a big rule for financial regulation. So, my feeling is that the massively complex financial regulation that we've got with Dodd-Frank, with the legislation in Europe, with the new Basel approach, all done with the best of intentions, all done by very good people. It's all done in part because we have to demonstrate that we've done a lot in order to control the system. The next crisis that comes along, most of it will turn out to be useless. And just thinking about the fundamental question, given that we don't know where the system could go wrong, how can we make it more resilient? And the great virtue of common equity is that it shares the risks across a wide range of people. We still have to worry about who owns different assets in the financial sector, where the risks are born, and what impact a banking failure might have on insurance companies and the insurance industry, or on pensions and the pension provision. All of these things are important. But if you think back, it is very striking that in the early 2000s, the US absorbed a much bigger loss through the dot-com bubble collapsing. But because it was shared through common equity, it didn't have a major impact on the economy. The problem in the banking crisis was that a loss that was a lot smaller became magnified in its effect because much of it was in highly leveraged institutions. And no one knew which of those institutions might fail, but they all knew that if they did, then there'd be significant repercussions for the rest of the system.
So where in this framework would you, or how would you think of what we're calling the shadow banking system? Those that, really don't have access to central bank liquidity. You talked a little bit about the insurance companies, but the big asset managers, the hedge funds, a lot of other financial institutions that are basically outside of that regulatory framework that commercial banks are in. What is your view as to how they should be dealt with?
Start by trying to distinguish between institutions that are carrying out deposit-like activities such as money market funds. I mean, I think it is pretty clear to all of us in Europe that money market funds either need to become more like hedge funds and offer people a flexible return, or they have to become like banks, and if so, they should be regulated like banks. But I think that hedge funds and fund management companies are quite separate. I mean, I think they're not banks. They're not taking the same kind of risks. They're clearly large. They may have an impact on certain markets. But I don't think that they pose the same potential systemic risks. And in many ways, I would like to see us encourage the view that risky activities, both saving and investment, are channeled through intermediaries which are specifically set up for that purpose. And I think fund management companies are very much like that. So I don't think they need to be brought in the net of regulation. And I think in that sense the phrase shadow banking is used far too widely. I mean, to me, one interesting aspect of hedge funds is that in the period from August 2007 to September 2008, many of my counterparts in Europe would always say to me that this is a terrible crisis. It's brought about by Anglo-Saxon hedge funds. After 2008, when they saw the problem was right at the heart of the banking system, including their own banks, no one ever mentioned hedge funds to me again. And no one in the general public worries about hedge funds. Some of these hedge funds make vast amounts of money and pay themselves enormous salaries and bonuses. 20% of them a year go bust. That's exactly what a market economy should be, and people accept that. I never found any popular resistance to that at all. Where the resistance comes in is the idea that institutions that pay themselves large bonuses in good times and get bailed out by taxpayers in bad times, that is unfair, and that is exactly what creates the resentment, and that is where we need to focus regulation. So in many ways, the way forward here I think, has got to be to define an area that we are going to regulate, and then to be clear there are certain things that we're not going to regulate. You may need regulation on various aspects of consumer protection. I don't think people should be allowed to telephone you after midnight and try and sell you something on the telephone. But that's consumer protection. But when it comes to financial regulation outside the areas of conduct and consumer protection, the prudential side, then I think it's actually very important that we don't extend the net of regulation so far that we end up trying to regulate everything, which I think will not succeed.
Just change the subject. One of the themes that is underlying what you're saying is the sort of inability to really forecast the future. I'm just wondering if you had the best brain power around you for a weekend. The people who you think are the most, not only the most brilliant, but the most experienced. And your charge was to specify a few questions, the answers to which you would love to know. You know you don't know them. You're skeptical, actually, that we could know them, but you've been given the charge to try. What is it that you feel you don't know that you would really like to know in order to, not to forecast the future, but to feel a little bit better that you could move more quickly or that you could move more effectively in the event of a crisis? What are the known unknowns?
Well, that's a very hard question. I think one question I would put to these extremely clever and experienced people is to say to them, if the only thing we could do was to monitor 3 numbers for each financial institution, what would they be? I'm very struck that regulation before 2008 was pretty intensive in the sense that there were an awful lot of people doing the regulating in the US inside the bank buildings themselves. And there were boards of directors. There were lots of people in there. So, you know, what was it they didn't spot? It's not because they didn't have enough information. In many ways, it's perhaps because they had too much information. There was so much going on. There were so many things they could have looked at. I remember inside the Bank of England in our financial stability area, you know, people said, oh, you know, why didn't you put more resources into it? We had well over 100 people working on financial stability issues. The problem was, once you get that kind of number of people doing it, you end up with lots of papers, each one of which is on a rather detailed subject. And everyone was, you know, overwhelmed with detail. The single most important number in looking at UK banks would have been the leverage, a simple leverage ratio of each major UK bank. That number, put in a table for the top 12 banks in the UK, would have told us an enormous amount about what was likely to happen to banks further down the road. In particular, it would have highlighted Northern Rock, and it was highlighted by the bank. We did send a memorandum to the FSA about that. But there was no mentality that here is a table, a simple table. It's got only 12 numbers in it, the simple leverage ratio for each major bank. What do you think of this? Should we be worried about it? What you got instead were long papers, everyone demonstrating that they're very clever in manipulating the data and the numbers, and the ability to step back and say, no, you know, let's just try and think of 1 or 2 things only that we should look at. That's one question I would ask. I think another one would be, what do we think is the outlook for the full employment current account balances across the world and also within the euro area? I think these are still large and haven't really been tackled properly, and to my mind they have the seeds in them of another problem further down the road. So that's an example of just two.
Yeah, those are two very good questions. So my final question is this. The last real attempt on a comprehensive basis to build a global monetary and financial system for the world was really after the Second World War. There have been lots of changes along the way, a lot of organic changes and lots of evolutionary changes, and obviously the system doesn't look very much like what it did in the early 50s or late 40s, early 50s. But and policymakers are really preoccupied now with kind of reacting to the last financial crisis in the most effective way that they can. But if it were a decade from now and things had settled down a little bit, when you think about the global financial system, and I'm including the monetary system as well, and if you were to just hypothesize, I realize there's no evidence that this would happen, but if the key countries, let's say the G20 got around the table again, and there was an effort to say, okay, we've learned a lot, it's a new world, there are many more countries, the markets are much more integrated, private finance is playing the overwhelming role. Are there two or three issues that you think ought to be tackled, really fundamental issues that would strengthen the global financial system for a long time? And I'm thinking about big issues that would constitute a stronger framework than we have right now.
So I think the first one I'd start with is to try and create a mindset in which people realize that the fact that there can be significant spillovers from large economies to other economies is a very important aspect of the world economy. That doesn't mean to say that countries should be forced to do something that's against their own self-interest, or that there should be artificial coordination. But I think a recognition that the policy debate is very much about the fact that we are all in it together, to coin a phrase, and that if we don't find a way to ensure that the policies that we adopt fit well together, then we could end up in a very bad position, as pretty much we are now. So I'd hope that the experience now would tell people that actually there was a great deal to be said for effective dialogue about how we are going to get out of this. And what I have in mind, and we talked about it over the last 10, 15 years at the IMF, was the fact that everyone recognized that there had to be a rebalancing of the world economy. But the view was basically that as long as each country did what it thought was best for itself, then we'd all be all right. Well, that turned out not to be the case, that you can get these big spillover effects. So I think what I put forward was the idea that the two big countries here that require adjustment were partly the US and China. It now includes certainly Germany. The idea that countries can go on indefinitely with trade surpluses of this magnitude, I think, is not sensible. Of course, in principle, you do want to allow capital movements and capital to flow from countries that want, for various reasons, to save a lot to other countries that want to invest a lot. It's not actually what we saw. In many ways, it was the other way around. So I think much of the magnitude of the imbalances was something that clearly was unsustainable. And then what matters is to get some implicit agreement on the timescale over which those imbalances will adjust. Because if two countries try and pursue adjustment at different time scales and on a different horizon, then clearly they can't both be right. There'll be some compromise which will be forced out of the equilibrium, and what you may get is just a weak world economy which slows down the pace of adjustment. And that's very much what we've seen. So I think China will have come to recognize that if it tries to adjust very slowly, what will happen is that countries in Western Europe that need to adjust more quickly will just stop buying Chinese exports. Domestic demand in Europe very weak. Chinese exports have fallen. China is not able to adjust in the timescale it would prefer because other countries have taken actions. I think there is scope for doing better by having not artificial coordination, but an exchange of views and genuine understanding that we're better off if we can somehow make our policy confident that we know what the other guy is going to do. That has not been true. I mean, the G20 has been pretty disappointing. I was there when it was set up with a great fanfare, but in many cases it was the emerging market countries that did not make a great success of this. The G7 handed the G20 the responsibility for managing the world economy in 2009, and the other countries did not really run with it. And I think that is very unfortunate. And it's also the case that politicians these days are very reactive. The whole style of government is, what happened today, what announcement can I put out that will make me appear on the right side? And that is, again, not a very good way to develop strategic policy reactions. I think central banks have a big responsibility in this area. But if I'm honest, the one area where central banks really fell down on was precisely in this area of the international arena, where we'd all meet and have a good time together. But nothing came out of those meetings that could not have been achieved by simply staying at home and doing our own thing.
Well, Mervyn, I want to thank you very much. Those were really interesting questions, and that you addressed in a very interesting way. I think the impression that I'm left with really is that this is a work in progress, and that we've learned some things, but we have a lot more to learn. And I'll come back to this notion of humility about what we know and what we can do, what we can see forward on. But it gives me a lot of confidence that people like you are really actively trying to improve a situation which is very, very complicated. So
two thoughts at the end. One is that I think for economists the message is, don't think that there was just one thing missing from our models, and if only we could put that into the model, then we'd be all right. I think that is an illusion, and thinking much more deeply and generally about these questions. One thing we haven't talked about is the importance of thinking about history. I think an historical perspective, well, I found far and away the most helpful aspect in thinking through what to do in the crisis. I think the second in policy is that the pressures on policymakers today are always to adopt a very short-term reactive response. That will not get us to a desirable long-run policy outcome. And the need for thought, for ideas, for a serious intellectual underpinning of policy, not just domestically but internationally, has never been greater.
That's a wonderful place to stop. Thank you very much.
Thank you.